All right, I
right.
think we'll start. We have 22 people.
You have
Mike.
22 people on?
Yeah,
Okay.
all right.
Mike, we won't see your pretty face.
But I can see you.
We see Mike here. All right, Mike and Morley. Mike, you want to start or?
Yeah, sure. So good evening, everyone. So I've kind of been interesting the last couple of weeks in the market. So I have a quick question for all 18 people, and you can either answer verbally or raise your hand. I'm kind of interested to find out, and I realize we have a very confined group here in age, how everyone gets their news, whether it's financial or regular. So
You want to listen to it?
No, it's for you.
I know. Melissa, you want to listen to
We'll
it?
have people coming online.
All right.
Okay.
You want to go around the room, Mike?
Yeah, just ask, just
All right.
newspaper, television, social media, to the exclusion of everything else, or any other way that you get your news. I'd be interested to hear. Okay, go
I'll
ahead,
start.
Barb.
Yeah, I get it from Wall Street Journal.
Okay.
Ameriprise itself, I log on to the website,
Okay,
and I get it from social media. Not really.
okay,
I get it from, I also get an email called Stock Twits.
okay. So you do not get anything from television, do you?
Not usually.
Okay. How about anybody else?
Yeah, Mike, I wake up with CNBC.
Okay. Is that where you get most of?
I can't take the other stations.
How about regular news, non-financial? Where do you get that
Regular
from?
news, I either listen to CNN,
Okay,
MSNBC, when I'm in the mood. Fine.
okay. Who else?
What I like to do is first thing in the morning, I have on my phone and iPad, I have Google News. What I like about Google News is it's kind of objective. It has, the Republican side, the Democratic side, and it has general kind of news stories all over the place. So it's not like just MSNBC, which is one thing, or Fox
Right.
is the other. So I like to get a cross section of all these stories.
Right, so
There's
no-
not much financial with that, but it's
Right.
very news.
No newspapers and no television.
Plus I get the Times, plus I get the local paper, plus I always watch the 6 o'clock and 6:30 news on TV.
Got it.
And the Today Show. Is that enough news?
Anybody else? I
Okay,
mean,
Alan, is Alan with us?
Sure. I get it from the TV, some of the different links, and I also get it from the computer.
Okay. Anybody else want to jump in?
can you hear me?
Yeah.
Can you hear me?
Yes?
Go right ahead.
I have a subscription for many years to the Star Ledger, and then I actually got rid of it and went online. But in order to do that, I had to agree to take a Sunday edition. So that's the only print version I have left is coming to me. Everything else is online, and I have a Bloomberg app, and I get the Bloomberg news. That's pretty good. And then I have CNN, like everybody else, MSNBC.
Okay.
But I do a lot of reading on my phone or my iPad, or when I'm at my desk. But it's more likely that it's on my phone because my phone is always with me somewhere.
Got it. How about Steve? Where do you get yours from? You're a techie guy.
Yeah, mostly online.
Mostly online.
RSS feeds, I usually get them, I have an aggregate reader, so I get it from
Right.
different.
Any television or newspaper?
Not much TV at all. Newspaper, I'll read the newspaper, but that's day-old news anyway, so I don't even
Right.
pay attention.
Okay. Anybody else want to jump in?
Yeah, I've been very happy with Morningstar
Morningstar? Okay.
and Zacks I get also,
Okay.
Yeah,
and a lot of things online,
A lot of things online. Okay. Interesting.
and the Wall Street Journal.
And the Wall Street Journal. Okay.
I got an offer that I couldn't refuse for $23 to get Barron's for 6 months, so I'm getting that now.
Okay,
I
Great.
get that too.
all right. Is anybody else? I don't see all 18 people. Anybody else that I'm missing? I'm not seeing everybody. Yeah. Anybody else want to jump in?
Yeah, I
Sure.
read the New York Times in the morning, usually puts me in a bad mood. And and then there's the Apple Stock Act, which has like CNBC, Reuters, Yahoo Finance, CNN Business. So I scan that, and that's how I have a segue into all those different services. And then I
Yeah.
watch the TV news.
Okay, Rich, I want to tip my hat to you, by the way. I see you're running for the board, and I think you'll be a great addition. So I tip my hat if I had a hat, but okay.
Thank
So
you.
great. I wish you the best of luck.
Thank
No
you.
politics.
Take
No
care.
Yeah,
politics.
I think we're using a platform here that's part of the common facilities.
Right.
Because so I don't think we should talk about the board election.
Okay. Okay. I'm just saying.
Thank you anyway.
I'm congratulating you just for running. Okay.
Take
Good.
it back.
Thank you.
Bad luck.
That's great. Is anybody else? Did I miss anybody else that wants to tell me how else they get informed every day?
I get an email every morning from CNN. It's the 5 things you need to know before you go out the door.
Okay.
There's a lot more than 5 things in there. I also read the magazine called This Week,
Okay.
and I use my stocks app for financial news.
Okay. All right. Okay. So that's interesting because I also have and younger clients and I too that seems to spend more time certainly on Facebook and Twitter, and they consider that news also. So it's kind of interesting how news has changed so much with social media over the last, I would say, decade, but probably in the last 3 or 4 or 5 years. Okay, so maybe do we want to talk about, because this is our last meeting before the national election. So does anybody have a feel? Well, I'll start it off. Does anybody think, I'm sorry? Does anybody think, I had a client that called me from Florida on Friday last week who said that a number of his neighbors were worried that if the Democrats would win, that the stock market would take a major hit between 10 and 15%. Does anybody with us think that it matters to the stock market who wins? I'd just be interested to hear what your thoughts are.
Well, just a point. The market has gone up the last few weeks, even though all the polls are showing that Biden's way ahead.
Okay, that's
So
a point well taken.
that makes you wonder. You know, I know I've heard about the concern about the Democrats, but it makes you start wondering, why is the market going up then?
Okay,
Well,
Good
I
point.
think
Go ahead.
historically, we've done better over 4-year periods versus 4-year periods when Democrats have been in office than when
Why do you think that's
Republicans
so?
have.
Yeah, why do you think that's so?
I have absolutely no idea,
Okay.
but I think that is the case.
Okay,
Well, you could look back at what happened when Clinton was the president, how the stock market did and how we reduced the deficit. And we had, we didn't have deficits. They were actually talking of discontinuing the 30-year bond
sure.
because they didn't have to fund the deficit because we had, and then if you look at what happened to Obama, when he came in, we had the greatest recession. And although it was very slow for over 8 years, look how he reduced the unemployment and how well the market did.
Mm-hmm.
So,
Good
but that's
point.
just the last 2. I don't know about the other ones.
Right.
I read an article, I think it was on CNN, that the chief economist at Goldman Sachs, as well as Moody's Analytics, believes that a Democratic victory ultimately would be better for the economy because there would be a lot of infrastructure spending, especially with respect to renewable energy. And the stimulus that would create would far exceed the stimulus that has been created by the reduction in regulations that was created by the Trump administration. This wouldn't happen right away, but over time it would. And if the market took the long view, ultimately it might be better in a Democratic administration.
Yeah, but what
Who's to
about
say?
that? What
Anybody else want to
happens
jump
with
in?
the taxes? What happens if Biden raises the taxes? I don't know how that would play in the market in a positive vein.
Well,
Well, how do you
some
expect
of
to
us don't
repay the
expect to
deficit?
make more than $400,000 a year. So we would not be adversely affected by raising the taxes. Plus, we'd be able to take our full deductions for mortgage and real estate taxes, et cetera. So I don't think that's a consideration.
Assuming this is a consumer-driven economy and there are more people that making less than 400,000 than more, and if the taxes don't go up and the people who are making less than that, there's more consumption, maybe, especially if their taxes go down. So that's a
Exactly. Correct.
Do most of you think that we can carry comfortably this 26 to 28 trillion dollar debt? That if we
No.
get something else passed,
Especially if the interest
without
rates go
having a
up.
negative impact on us?
Well, you have to worry about whether interest rates go up from the current levels. That's going to be quite a burden to carry it.
Sure.
Michael, can I ask you a question? I mean, how everybody has had their taxes affected by the Trump's tax change.
Mhm.
How many people have been positively affected by it as opposed to the reduction in, I'm not talking about portfolios, I'm talking about taxes now. Okay, how many have been positively affected with a reduction in taxes as opposed to the change which took place with the elimination of the full deduction of interest in real estate?
I agree with you.
Because
I
there was
agree.
an al-
Mine was negative.
There was an alternate minimum tax that existed, which took away a lot of those deductions anyway, before the tax cut. So to me, it was actually a positive because the AMT went away.
Well, it depends on your situation. For me, I had to pay a
Right.
few $1,000s more because I couldn't deduct the real estate taxes. Where I used to live, we used to be pretty high.
So
All right, so let me-
we've got, when we talk about change in taxes, you have to consider what's really taken place. How many, we have what, possibly 20 people here? Barry's the only one so far that had said yes. He was favorably impacted by that.
Yeah, I
change.
was favorably impacted, because I always pay the
Okay,
AMT. for
there
years.
are, but the percentage as advertised is nowhere near what really took place.
What really took place?
What I'm saying is the effect, most people, I would say percentage wise, most people were negatively affected, more taxes rather than less.
I have a question. How many of us are negatively affected by having interest rates at near zero? We're at a point in our lives where hopefully we have nest eggs to live off. Not all of it is in dividends. Some of it actually might be in the bank earning nothing. That's not good for seniors.
Okay,
No.
that's certainly a valid point.
Unfortunately, it's been like that for the last 7 or 8 years.
Not as drastic. It
Not
went
as
up to about
drastic as now.
3% a year ago.
Yes, yes.
Do we agree that the Fed had to do what it had to do at that point, or no? Do you-
That's
do you-
above my pay grade. I don't know. I really don't know.
Okay,
Well, you look at what happened since they did it, and things didn't get worse, and they prevented from having a depression or anything. So I would
I
say
think
they
that's
did the right thing.
that's a very valid point.
Well, things didn't get worse for certain people and did get worse for other people. As a country, though, we seem to have been helped somewhat, but we're not at the end of this road. I
No.
don't know what will happen.
Gentlemen, I just want to go back a second about that AMT. For those people who were in the AMT,
I joined without
you may be forgetting that you were getting an AMT credit. I don't know, somebody was over talking me, so I have
No,
no.
that's all right, go ahead, you're okay.
There's the AMT credit that comes into place, and a lot of people don't realize that when you ultimately got your tax returns from your accountants, you may have failed to look at that bottom bracket to show the difference between the AMT. Well, that's the section where you're going to see that you very often got an AMT credit. So when people complain about the AMT, they very often forget about the benefits of the AMT credit.
Okay.
That's enough.
Anybody else want to participate that didn't yet at this point?
There's a couple posts on the chat, Michael.
I'm sorry, say again?
Yeah, from Ellie, Carl to everyone. She says, no, negatively affected, so much more in taxes this past year. That's what she
Good.
says.
All right, let me throw
Did she
out
make
one.
a lot more money?
Yeah. And let me throw out one other point to you also, as we're getting into the 2020s here. How does everybody start to feel about having to, well, we talked about that we're going to carry somewhere 26 to 28 trillion. You can't even get your arms wrapped around that number of debt into 2021. Now we're facing, as we could see, we may disagree, between forest fires, hurricanes, and the rest. We're probably facing in the 2020s, something's happening to the earth and the atmosphere. Does anybody feel like we should be spending extra money there to try to do better than we're doing right now as a country?
You move to Nashville.
Somebody
wants to move to Nashville.
Who's talking back there in the background? It's very hard to hear when they.
Yeah, I'm sorry. Somebody said about moving to Nashville. I don't know if that'll do the trick.
Unfortunately, we have 28 people. And
all right, jump in.
Yeah.
Does anybody feel like we should be spending less money, more money? And trying to balance the planet out a little better?
Absolutely.
Well, we should be spending money on renewable energy sources.
Right.
Absolutely.
Okay. And
Well, the damage that is caused by these fires and these floods alone, if you could save that alone would be worth fixing it. You have to do it, otherwise it'll get worse.
I think we can say that the market is recognizing that. If any of you are
Yes.
following Tesla or the company Nikola that GM is hooking up with on batteries, the market is rewarding them with extremely high multiples. So you should definitely take a look at that. All right. I got one other question, and then I'll give you a feeling, at least between Morley and myself, where we look at this market going forward. Assuming that we have a vaccine coming, let's not be overly optimistic, as some are. It's coming probably, if you listen to Fauci, somewhere at the end of the second quarter or beginning of the summer, third quarter, going into next year, that it's reasonable distribution, so on and so forth. Would all of you be okay about taking the vaccine and then starting your new normal life? Or how are you going to approach that?
It would depend on who recommends it.
Okay, assuming it's the CDC and Fauci.
Fauci, okay. I don't know about the CDC because they're controlled.
Okay. Well, will you feel better
If Fauci's willing to take it, I'm willing.
Well, didn't Redfield say that a mask is just as good as a vaccine? I'd probably stick with the mask for about 6 to 7 months, see how people did in the vaccine, and then I'd go with the vaccine if it looked like people were doing well with it.
I agree 100%.
I agree. Good idea.
Let me ask you this question. If you take the vaccine, that's supposed to give you antibodies ultimately, correct?
So they say.
Test to show that you've got sufficient antibodies, then I might take the vaccine.
Okay. Yeah. And it depends. There's going to be more than one vaccine. There may be as many as 5 altogether. And some of them are one. The Pfizer looks like it's going to be 1, but the others look like you're going to need a booster, like the shingle shot after. Okay. At this point, that could change. Yeah. So if we assume that we're going to be reasonably vaccinated by the middle to the last half of 2021, will you start assuming your normal life, or is there a new normal coming up?
Well, it
Flying,
depends how long the
cruising?
Mike, it depends how long the vaccine lasts. Like they say, the flu shot only
Well,
lasts like 3 to 6
Well, what's the
months.
difference? So you'll take another one the next year. That's
Yeah.
okay. So assuming, are you all ready to get started by the end of 21 or 22 in a new
I
normal?
can't tell you the
like
time frame, but I would step back and take a look and see what's happening before I went to a ball game or the theater.
Mhm. All right. Anybody else have any feeling on this?
You know, the
Well,
reason
would
life
they
went
be-
back to normal after the Spanish flu is that everyone had herd immunity.
That's right.
And there's a questions as to whether you can get herd immunity with COVID-19 or how many people have to have been infected. There's just a lot of unanswered questions. So it's hard to say at this point when.
So we may sit on the sidelines longer than we think, right? From that point of view. Okay.
Would they be injecting a virus so you can build up your own immunity? Is that how it would work?
No, it's dead. It's dead virus.
Oh, it's dead. So people with an autoimmune deficiency wouldn't have to worry about that.
But they
Okay.
say that some of the vaccines may only be 50% effective.
Correct.
Yes.
And that'll be acceptable right now to the CDC.
Yes, to the
Okay.
FDA.
All right. All right. So at least we have a feeling. Anybody else want to jump in? Or of all 18 or 21? I don't see everybody, but are we missing anybody? No. Okay. Then maybe
Yeah, but Mike, we have a number of people on it. It doesn't show all, I haven't figured out how you can show all of
That's okay.
everyone on one screen. We have 2
Gets a little
screens.
bit. Okay. Okay.
You have
I
to
got it.
scroll left or right.
All right. So
Yeah,
thank
Mike,
you. Thank
going-
you all for
going back-
participating.
Going
Yeah,
back to
go on.
talking about interest rates, does anybody feel there's a positive thing if rates go up?
No, I guess the savers do, don't they? The people
What?
that save and are getting nothing at the bank right now.
Well, you have to look at it this way, that if rates go up, the lenders, which are basically people who have CDs and bank accounts, buy bonds, they're going to get more income. And if you got more income, you're going to spend more money. So higher interest rates may not be, the worst thing in the world. Runaway interest rates could be. If rates go up on a 10-year treasury to 2%, 2.5%, it's not a terrible thing because it will put more money into the economy.
Or if rates go up, it's going to cost more to service the national debt. How is that going to
Correct.
affect things?
Well, if
I said
you
this last
have
time.
inflation, it might be an indispensable thing to get it under control by
Mm-hmm.
lifting rates. I don't know what's going to happen. The Fed claims they are going to tolerate inflation, but if there is serious inflation, I wonder if that will happen.
Well, inflation will only come about if companies can raise prices. Today, with the internet, it's very difficult for many industries, many companies to raise prices on anything because you go into, let's say Best Buy, you see a television set. The first thing you do is you go on to Amazon, see what that set costs there. So it's difficult to raise prices, and 70% of inflation comes from individuals purchasing. And right now, individuals, are not looking to get more money from their jobs. They're not looking for pay increases, and therefore, that's going to keep inflation low. So I think inflation is going to stay low for a while. And interest rates, Mike brings up a good point about the deficit and the amount of money that's being borrowed. But if you go back to, let's say, the 70s, from that time on, when the national debt hit $1 trillion, it was the worst thing in the world. We're never going to get out of it. It kept going up and up and up, and we've done well. So I'm not so sure that what the Fed is doing now and pumping money into the economy, raising the debt limit, not the limit, but raising debt. I'm not so sure that that's the worst thing in the world. If they didn't do it, we don't know where the economy would have been.
I agree with Morley that, given the circumstances and what you folks also say about when you're going to be comfortable, whether it's the old normal or the new normal, I think the Fed is probably committed, at least until almost 22, to keeping interest rates where they are, which is next to nothing. 0 to 0.25. The only thing that could start to raise interest rates is that the bond market in the past 50, 60 years has sometimes led the Fed accordingly. So in other words, interest rates can creep up for a number of different reasons, even without the Fed normally raising either short or long term. We'll have to see if that's so. That does come about with sometimes when we're printing as much money as we are. But in challenges of what we're looking at right now, the Fed can only do what it can do. And it's doing right now is keeping the economy right on an even path. Lower interest rates, and even most importantly, keeping all the municipalities afloat. I think I mentioned in the last couple of meetings, by being the buyer of last resort in the bond market that is considerably bigger than the stock market, okay? Fixed income way outweighs what equities are. And that has given you a real strong fixed income market that's very organized and not disruptive. Extremely important for the entire global economy, okay? So I do understand those people that are running from bank to bank trying to get more than 0.1% or 0.2%, whatever. But I think you're probably going to have to suck it up for the next year or so. Either that, or you're going to have to be willing to take more risk on the risk curve. And that's up to each one of you individually. You can go out on the curve further out, okay? As far as corporates, there are quite a few things that you can do, but more risk than you may be comfortable doing. So that's going to be, that's going to be up to you to how you see that. Is anybody taking a chance and change from CDs in the bank to something else to get some yield? Has anybody been involved in that? In moving some fixed income money around?
And I had something explained to me about notes tied to the indexes.
Okay.
And I was first intrigued by it. Then I'm saying, oh, wait a second. And it's tied to an index that's tied to, I think it was the 500. And I said, if I was going to do that, why would I not just go into an index fund?
Okay.
And because when you're buying these notes, going into these notes, I thought that I give myself potential for a double whammy if the underlying notes go bad, So,
okay, so let me just say this about notes and fixed income. If fixed income will have some volatility, not like the market, but it will go up and down. That money that's in fixed income, you have to look at it as not worrying about it going up and down. It's providing you the income that you need, okay? And you can't nitpick yourself or micromanage what's over on the fixed income side, all right? I'll make one other suggestion that I think maybe you'd reasonably like to look at. Take a look on fixed income on some preferreds of well-capitalized companies. I urge you to take a look that you may get some better yield, and you can buy the individual preferred, whichever way you buy, like an equity. Just know there is risk on the debt curve because the preferreds are just one step above common stock. But they generally, for good companies, they stay well within a boundaries. And if you take a look at JP Morgan and Bank of America preferreds. If I mentioned that to you before, it's worth mentioning again, okay? I think you'll find the yield. I'm not saying that you should take, 50,000 out of the bank and bet the farm on it, but you may want to find that that'll balance you out a little better than getting 0.1%. Again, not FDIC insured, but I'm not that concerned about JP Morgan and Bank of America being able to pay on their preferreds. The ones that are out there right now generally are about 5-year non-call, and then the issuer can call it back.
Well,
So
Morley,
see if
you're
that's
just
helpful.
addressing the credit risk, not the risk of rates going up and losing principal because of that.
No, I'm addressing both. Because in other words, if you get if you get your preferred called on you, you will get your principal back at that point. If you don't care, okay?
If rates go up, you won't get your principal back unless
Oh, yeah,
you, on preferred stock.
Oh, you will. Why won't you get it? If they call it back on you?
No,
And
if they don't
if the-
call it back on you, why do they call it back on you if rates go up?
If well, they may still be too high. They may get a better deal by reissuing at that point. It could be higher than it is now and they'd still come out ahead. Okay? All you
Okay.
care about is getting your quarterly payment from there. Okay? If they're called, some of them may go out 20 or 30 years. All I'm saying is that you may want to take a look at a balance in case a number of people said, "Ooh, I can't get any money out of the banks these days." Again, not FDIC insured, but if you're willing to go a little more on the risk curve, you may be able to satisfy your need for income, if that's what you need. If you don't, then stay where you are.
Are there any preferred stock funds as such where you may consider that instead of buying into individuals?
Sure, absolutely.
Got a better
John
way?
Hancock has one. There are a number of them that are in the preferreds. But again, if you're going to go toward preferred stock funds, know in order to get the yield, they're going to take more risk than you may be willing to take. Okay, just know that. You're buying a basket and it's good. You can sometimes get as much as, depending on the 5.5% to 7% yield. Okay, but your principal can go down. Okay, and probably the major reason, it depends which ones we're talking about, some of those companies that may be smaller companies that issued preferreds could blow up on you. So therefore they don't get paid, all right? So you got to take a look at that carefully. But yeah, I think that's something to look at. Again, if you're finding that you're not getting enough income for what you need income for.
Mike,
And again,
there's-
you have to be comfortable. You have to be comfortable going out on the risk curve. If you're not comfortable, then stay where you are.
Don't do
Mike,
Michael, what about something like some of the individual utility preferreds?
Yeah, that's another very valuable place. Because even if utilities get into trouble, you know what? They generally get bailed out and they're okay. But pick strong ones. Pick like American Electric Power. I was going to say Duke. I like Duke, but Duke's in the process of possibly being taken over. Okay, so watch that. The old Florida Power and Light is okay in preferreds.
NextEra.
NextEra, thank you. So those are good. If the company is solid in the ratings, and if you're doing your homework, then the preferreds are going to be solid too. Okay, so you'll be all right. It's just that if a company goes under, the preferred is the lowest on the debt scale. So after the employees and mortgagors and so on and so forth, you're one step above common stock. But if you're in a good, solid company, again, you have to be willing to step up on the risk curve. If you're not, then stay where you are. You can do a little better in corporates than you can do in CDs these days.
Mike, there's an
Are there
ETF.
common stocks of any solid companies paying the reasonable dividend?
I'm sorry, say that again?
Are there common stocks of very strong companies that pay a reasonable dividend?
Sure, take a look at Verizon. Very good balance sheet and a good dividend, okay? Again, the gentleman who mentioned utilities, generally 3.5% to 4.5%. Again, depending on what you consider, good dividend, okay? Of all of them between utilities and telcos, I may have mentioned this before, go to telephone. Now there you got a little bit of a risk that they may drop the dividend at some point. The risk is in that takeover of Time Warner a couple of years ago. Tremendous amount of debt on the balance sheet. But from telephone right now that's trading between 28 and 29, you're getting almost, I think, a 7% dividend, okay? It's healthy, but there's a reason for that, okay?
But they've been saying that for 5 or 6 years already.
Yeah, so, I'm just...
So it keeps going.
All I'm doing is acknowledging the risk that's
Yes,
there.
yes,
Nobody's
yes,
giving
yes.
7% because they're AAA, okay?
Right. But NextEra also gives a nice dividend, and the stock has appreciated very nicely.
They're
in the last year.
they're the ones
Unbelievable.
that are attempting to take over Duke. We'll see how that goes.
Yes.
Molly, you got anything good for us today?
I was going to say that there's an ETF that is a preferred stock ETF. Its symbol is PFF, Peter Frank.
We own some of that also. Yep, that's a good one.
That pays, I think, 5.5% dividend.
Just
return.
again, don't get crazy about the valuation on these things, because if you do, you'll drive yourself crazy. Just know what the income is coming in and give yourself a flexibility range of what's going on as it's priced in the market. And it's more volatile than a bond. The bond, you know, in 10 years, if the bond comes due, you'll get par. And these are ongoing forever. But if they provide you the income, that's what you bought it for, okay? Good. Anybody have any questions as we're going into the fourth quarter of this year?
Oh, Mark, it's on.
That's it. See Lynn Bender.
Any questions?
That's Lynn Bender, yeah.
I couldn't hear.
Gary has a question.
Okay, go ahead.
What do you think about the Texas Instruments spinoff?
I don't have any comment on it.
What they spin off?
I'm not sure what this,
IBM.
but they're spinning off a whole section of their.
Are you talking? You're talking IBM, not in Texas.
No. Oh, excuse me. Talking IBM, correct?
Right.
Okay. So IBM. Okay. So IBM has been in the doghouse now for the last 10 years.
Right.
Maybe longer.
Corporate culture, slow to move in a very fast-moving technology market. Okay. They saved themselves 10 and 12 years ago by servicing so much of enterprise hardware and software. By enterprise, we mean corporate. Okay. In my company, we use IBM just to service. We don't otherwise use any other IBM equipment. All right. But even as you see them restructuring, so the lady who's now the executive chairperson, and you see the new CEO that came in, I think late last year, if I'm not mistaken. All right, so what's the deal? The deal is the following. They have decided to spin off into two companies, and this will take place, it looks like, third or fourth quarter of 21. The new IBM is going to be in the cloud, okay? Finally. And what did they build a cloud business around? Their acquisition, which was no small potatoes, $34 billion of Red Hat that they bought, I want to say about 15 months ago. And that's where the business is right now. That's what's going on. And it's not necessarily in software. You not want to step into Cisco's part of the business. They're struggling enough. The chip business is extremely competitive, let alone foreign competition. So you're stepping up into the cloud to share and to be able to store, all right? So the new IBM is going to be the cloud business. The old part of IBM, which there is no new name for this company yet, they're going to name it next year, is going to cover almost everything else. So from anywhere where they have software to hardware to the service part of the business. And service business, you could have the amount of servicing they have, you could create a whole nother company like that, okay? And that'll be the slower growth and probably most of the dividend, because IBM is giving you a significant dividend and the earnings per share is well covered on the dividend. So you could even say, okay, maybe this financial engineering that they're doing may be worth it. So you'll notice that IBM, that's been trading for the last year, I'm guessing about 120 to 125, jumped this morning and it opened at 134, I think. However, by the end of the day, I think it fell down to close to 130, all right? So the market's trying to value what this new business model is going to be like. The growth part, again, will be the new IBM. the probably more dividend and slower part will be the service and software and hardware and whatever else that they're involved, the non-cloud type of business. I think it remains to be seen. Watch what the market values it. The dividend, like I say, is pretty well covered. You hate to get into technology just to buy dividend, okay? But the dividend is definitely better than what you're getting in plenty of other places. You're taking the risk like you're buying any other company. Does that answer?
Yes,
asked?
that's good.
Yeah, yeah. It wasn't Texas Instruments, it's IBM today.
Yeah.
Anybody else? Anybody else got any questions that are going on? Does anybody see a significant change in the market over the next quarter? Is anybody concerned about chaos in the country affecting the financial markets, or you think we'll work our way past that?
The election.
Yeah, sure.
Right.
Anybody have a strong feeling one way or another?
Why is the market going up right now?
Because
Yesterday, 500 points.
it's looking past the election.
Mhm.
Okay, the market tends to be a prognosticator of anywhere from 6 to 9 to 12 months. So however this is going to shake out, they feel that it'll come out all right on the other end, including the virus. Yeah. Now, that doesn't mean that when you got smacked with the virus in March and April, the market didn't drop for those days close to, 28 to 32%, depending, because everybody ran for the exits. Okay. So somewhere along the line, the consensus right now in the financial markets are that no matter what's going on here, we will come out the other end come January 20th. I do have some clients that are raising some cash right now, just as a defensive move. So, you should know that. Yeah, I think you have to take a look at this and see what you think and decide, where you want to be. I don't think raising cash is a bad idea at this point. The markets seem to be hitting, if you look at S&P, it's kind of hitting the top between 33 and 3,400. I think technology, which has been a little bit overvalued by any kind of metrics, as also you'll notice in some days the NASDAQ is even pulling back. So, we don't go up forever, right? I think.
What about the Department of Justice starting these inquiries on Google and Amazon and these other ones?
I think that'll go on for a long time. Microsoft, IBM settled with the government and the EU. I think that's just news. Okay. Yeah, I think there may be some validity to it, but I think there's always in that area compromise. I don't think anybody's looking to break up companies that literally employ tens and hundreds of thousands of people in this country.
I've got a question, Michael, for everybody here. Let's say tomorrow you were given $1 million in cash and you had to invest it. What would you do with that money? How would you
buy a house in Stonebridge?
There you go. They're going fast. I had somebody move out across the street from me, and a new person moved in the next day.
Right. Let's assume that you needed $40,000 a year to live off of. So what would you do with $1 million? I mean, would you put it into bonds at 0.5% or 1%?
Do nothing. It'll last for 25 years.
Well, you can do that.
Depending on your age.
Right.
Does everybody pay less in taxes than I do? How do you make it with a small amount of?
Because, if you've got to put the money to work somewhere, do you put it into bonds where you get, 0.5 to 1%, maybe 1.5% on quality stuff, but you're taking some risk because you got to go out a little bit on the yield curve? Or do you put it into stocks? Or do you put some of it into stocks and the rest you keep in cash and, that's your little savings part? There's no place to go and make any money on investments today other than the stock market. So you have to take risk. You have to hold your nose. Just make sure you don't have too much of that money into stocks because the market can have a significant drop at some point. But, you're not going to put it into bonds like you could have 30, 40 years ago and gotten, 4, 5, 6% in bonds. That's the reason I think that the market is holding up as well as it is. There's no other place to go. And this will end at some point, whether it's 6 months, a year, 2 years, whatever. In the meantime, dividends will give you better return, better income than you're going to get from bonds. So you should be looking at some stocks that pay good dividends, and that'll help mitigate the fact that you can't get a good return on the bond market.
What about foreign bonds?
I don't know about foreign bonds. You know what?
I'd be careful there.
And I wouldn't do that.
Yeah, I'd be careful. Let me leave you with a couple of thoughts, even in the marketplace. I look at it as a two-tier market. Certainly your technology companies and your companies that are benefiting from the virus because they've met it head on and they figured out how to do it. So I'm thinking of companies like Walmart, Target, Amazon, so on and so forth. All right. I think you want to be careful, and it depends what kind of investor you are. I think you want to be careful of the industries that are really getting whacked on the side of the head, and are you looking at a new normal? So in those, I include the cruise lines, the hotels, and the airlines. It'll be interesting to see if by the beginning of 22, not 21, 22, that we get close to a new normal that's close to the old normal, okay? If you're an aggressive investor, if you want to think that you're picking up some real value, then don't forget, go for the best in class in those sectors that are getting whacked, okay? Just don't go for the yield. So the idea of Verizon versus telephone, best in class, Delta versus United or American, okay? If you're going to head and say, okay, the sector's whacked, by 22 or 23, we'll be finished with the virus and things will get back to normal. Maybe, maybe not, hard to know. So that I wanted to share with you, that's a decent way to take a look at the equity market right now and take advantage. And put on your seatbelts. I think you're going to see some volatility for the fourth and first quarter of next year. Okay?
Mike, I got a question.
Yeah, go ahead.
Yeah. Anyone taking a cruise in the next year?
Everybody's friends.
I have one planned for April to Japan, but I'm going to cancel it.
You could get sick on the cruise line before the virus. They had plenty of the neurovirus, right? So
I would have been on one right now.
there you go. So that's again, if you think that the cruise lines are so undervalued and you're the smart long-term investor, make sure you get the ones with the strong balance sheets. There will be companies that will get through this, okay? And you can look back in 24 and 25. Well, I was a genius back in 20 or 21. But just know that that's a different type of investing, of what I almost call deep value investing. They're deep.
But some people are not only investing for themselves. At this stage of life, maybe we're investing for our children too, as you know. So if you have enough to live on, you may want to say, okay, I'm going to take a part of my portfolio, invest it for my kids.
Okay. How old are your kids?
So that's an entirely different picture.
How I feel about that is my children are old enough to figure out how to invest themselves. Okay.
Yeah.
But I understand what you're saying. Could be for the grandchildren or whatever. Okay.
Grandchildren,
Yeah, sure.
Absolutely.
I would stay, in that case, I would stay with quality companies, no matter what, that you can. So, okay.
I think the whole
If you're
thing.
investing for your kids, you might want to take a little more risk because you look at the kids' long-term perspective. Our perspective is pretty short-term, but the kids have a long-term. You might even buy bonds that go out 30, 40 years just to get a higher rate, because we're not going to be around, but they might be around.
Speak for yourself.
On the bond curve, I would take this I would personally take the lower yield at first and have the bond come due and let it flip over, be it called or matured. Because sooner or later, if you watch over the last 50 years, how bond yields go, as well as they go down, they go back up. Maybe not as where we want, and maybe we're getting into a society where the government is going to be supporting us. You got to kind of get the feel here that the government is taking more and more responsibility for the individuals, okay? As much as everybody, whoever's going to be on the right side of history here. Because I don't understand the mask and no mask situation. It just seems to me that the governments in the Western world, let's forget China and Russia, are taking more and more responsibility for their citizens. If you go back to the beginning of the 20th century, the banks went bankrupt every 6 to 8 years, okay? There was no FDIC. That's too bad. You put your money in the bank, you lost it. Today, there's all kinds of insurance against us as being the individuals that you won't lose your money. Healthcare is becoming more of an issue. When I was growing up, you were lucky to have major medical. That was about it. Today, we're talking about everybody that's living in any of the Western countries should have some kind of healthcare, whether we get taxed for it, whether they kick in, whatever. So it's very possible that we may be looking for a very long term on low interest rates, if for no other reason, like Morley said, that was, maybe Morley didn't say, somebody else, to fund the government, because they're the ones that are constantly rolling 30-year paper to fund the deficit. So you keep their deficits as low as possible on that end so they can support you as citizens. So it's not like, you know, in the Daniel Boone, Davy Crockett days. It's getting to be more of a society where the government, and we're living it right now. Who isn't on Social Security and Medicare? Raise your hand if you're not, okay? So right there, you're in it, whether you wanted to be or not, or whether you feel like, you know, you want to, you want to wear whatever kind of cap you want to wear. So this is the situation. That's the way history is starting to go. So you can fight it, or you can join it and try to be as smart as you can in doing your investing. But that looks like, as we're finishing the 20th year of this century, that's definitely the way that the United States is going. It's the same way as many of us may say, gee, I remember when I grew up, the Caucasians were totally in charge. It's changing now. You know, you saw the thing coming out of Kentucky. The state attorney general is black, okay? And so are many of the police chiefs. That never would have been as I was growing up as a kid. The world is changing. So you have a chance to either get on the train or be left in the station. That's how I look at it. So, and that's part of the struggle that's going on right now politically in this country. There's a significant amount of people that want to try to be what it was. You can't go back. So try to make it as best as you can, be inclusive, okay, and try to be fair to yourself and everybody else. I think that's where we're going in this next decade.
All right. Are there any other questions?
How much more time do we have, Lenny?
Well, we can go on because this is the community's Zoom account. They're nice enough to let us use, and there's no 40-minute limit.
Okay.
So it's just how much we want to talk. That's all. I'm not telling you guys to sign off. I'm just saying if we have something to talk about.
Lenny, the quick answer was 5, 10, 20 minutes. That's it.
Michael, I'd like to ask your opinion on something. I recently, 2 months ago, invested in a 2-year note. It was 7%, and it's supported by the Standard & Poor's and the Russell 2000. And I have the price at the time when I invested, it can go down 45%, and I lose no money. And in 2 years, I get quarterly, I think it's quarterly or every 6 months, I get interest. And in the end of 2 years, I get my money back. Have you ever heard of anything like that?
Yeah, you have limited upside, right?
Right. That's a structured note.
I really, that's correct.
I really don't care because I get 7%.
No, I understand, but it's what the other gentleman said. It's a structure. Yeah, there's a lot of them out there. You can have them based on not
That's
only the S&P, you can have it based on a certain company. and
That's
so
correct.
on.
I have others that are based upon 3 different stocks with a
Yep.
40% floor. And I was getting between 10 and 12%.
Good. Look, I think it's your model of investing. For
Right.
me personally, if I go
That's
into
speculative.
equity, I like to go into equity. If I go into fixed
Sure it
income,
is. But
this
so
is
is
kind of like
anything
a
you invest in.
hybrid. If you're comfortable with it, it's fine.
Yeah.
I have a question. What happens if it drops below 45%?
I lose principal.
How much do you lose? 45%.
I could lose 45.
Okay. The problem that I see with those structured notes is that if you're a fixed income investor and you're looking for income and you buy one of those, you're taking on the risk that the market drops 45% or more.
That's true.
Not going to happen. Well, you know what? You buy it and you find out that this does happen. So I'd be very careful of those things.
Sure it does. I have one or two that have one of the 3 stocks is just a little bit below the 40%. And but they'll all mature in 2022. So I feel it'll go back up.
All right.
Can you afford the loss?
If I had to? Yeah, because the way I look at it is I made more in interest than I would at the 0.5%. So
well, yeah, but that may be you're going from one part of the curve all the way to the other end.
I understand.
Yeah. So what Morley's saying, look, for fixed income, many investors use it for monthly income. So that's one thing for fixed income.
Right.
The other thing is if the market tanked like it did in March and April. So I'll throw out to you, not to be falsely comfortable here.
That's correct.
A, what if the Fed didn't step in? B, what if Congress didn't go ahead and already print $5 trillion worth?
I know.
All of your notes would be below 45. We would be in quite a bit of a chaotic situation.
Sure, the whole country.
Right. So if you have $1 million and if you're telling me that these 3 notes say make up 100,000, then you have to say to yourself, okay, I can afford to lose $100,000 that I was kind of counting on as fixed income. And that could be you. That could be fine.
Yeah.
Most people look at their portfolios, and when the markets go down, fixed income usually holds. Okay. So it's partly psychological besides financial. So just be careful here that we may be entering a volatility part. It may be political,
I know.
economic. Just be careful.
I will, of course.
Okay.
Thank you.
And you're getting rewarded for the risk. Okay. You just said you're getting, but just make sure. Everybody always tells me when I have a new client, oh, I've been in the market risk, blah, 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 blah. All of a sudden the market tanks 35%. They're the first people to call me on the phone. Should I sell half of my portfolio? All right.
Right.
So you'll find out how much risk you can absorb when it goes that way. Okay. So
that's at maturity date.
I'm sorry?
It's at maturity date when I have to worry about it. Yeah.
I understand.
Okay. Michael, you consider the dirty word annuity?
Yeah, I mean, I have clients with annuities. You're paying a lot for insurance, okay? And with annuities, it's very costly every year. So if it's worthwhile, like life insurance, you pay a premium. You're paying, depending on the annuity, you're paying with between 1.5% and 3%, depending on the bells and whistles that are tied into the annuity. And what's the annuity for? That's my question to you.
What is it? Well, okay, it's for potentially downside protection with upside risk. I'm sorry, upside reward.
Right. And how much of your portfolio does the annuity make?
Not a significant portion.
Not a significant. Okay. So there's your answer to your question. Originally, annuities, when they came out in the late 70s and 80s, mutual fund companies were looking to compete with insurance companies. So that's how we got into that business. Okay. people wanted an annuity because the company, the mutual fund company, so on and so forth, promised, I'll give you $86 a month for the rest of your life. They came out pretty good, and there was a death benefit payment on it. And there is a death benefit payment on just about all of them. I think in this day and age, 21st century, personally, you're paying too much for what you're getting there. If you want the downside protection, generally you can be in fixed income and still get it, okay? And when you take a look at the next annual statement or the last one, take a look at what you're paying for that protection, especially if it's a small part of your portfolio altogether, okay? So then you say to yourself, if it's a 7 or 10 year annuity, you can get out of it with no backdoor charges. And I personally, I would do it. You may have to pay, is it in an IRA or is it in a after-tax account?
IRA.
IRA, so perfect. I would get out of it and get yourself some good corporate paper and so on and so forth if you're looking for the downside protection, okay? That once it's over, I wouldn't pay a
So
fee.
I asked you if you thought of it as a dirty word.
No. I've used it in cases. To protect the downside for people. Okay, I have used it in the 08, 09. I can't say that I've bought it in the last 5 years.
Yeah, Michael, let me add to that. I would say most people that buy annuities do not fully understand how they work and what they're going to get.
Correct.
If you're willing to give up your principal for a series of payments for the rest of your life, then annuity is an okay product. But most people buy the annuities, but they're really not thinking that at some point they're going to give up their principal.
And most people don't even use the monthly payment for the most part. It's almost like this particular individual just said, that, you're looking for protection with some upside. You will get upside. I mean, I've had them from 08 or 09, and I've recommended, what I've done is in after-tax accounts, I've rolled them over into fixed income annuities, to be honest with you. The equity, they trail the equity market every time. If you take a look at 08 or 09 to 2018 and 19, they don't do as well as the S&P. Okay, so but I don't want to knock out. There is a certain amount of insurance that you feel that on the downside you have the protection. Good, as long as you know that you're paying for that, you're fine. Okay, and I would make sure that it's a small amount of your total portfolio.
They talk about guarantees. What's guaranteed? People think they're guaranteeing the returns. They're not. They're guaranteeing the withdrawal rate.
Right.
Guarantee how much you could take out of your own money is what they guarantee. So you got to be very careful. The sales literature is maybe 2 or 3 pages. The prospectus is about 1 inch thick because it's got all of the caveats in there to protect the insurance companies. So in most, I'd say in a small number of cases, annuities are the okay thing, but in many cases they're not.
And notice that it's the company, so that you're comfortable or uncomfortable, it's the company that issues it to you that's guaranteeing it. How good a shape are they in? Most of the times with mutual fund companies that have issued this, Transamerica, John Hancock, whatever, even if they got into financial trouble, okay, the financial regulatory of the SEC and so on and so forth would have another company take them over, just like in the insurance industry when you've seen an occasional insurance company go down. They've raised, since the 08 or 09, they've raised the amount of liquidity that they must have on hand all the time, okay? The one thing you wanna, you gotta be careful of, and one thing that's troubling me, say in long-term care, GE has just been given a Wells notice, okay? They wanna know where all that money is going because they have to cover that division of GE that they spun off for long-term care, okay? So you get into a little bit of those tricky areas right now. Yeah.
So given the fact that our,
Go ahead. I'm sorry.
I thought you were through. I'm sorry.
No, I was going to say, again, Jerry, you can go and I'll
Go ahead.
So given the fact that our long-term debt is skyrocketing, how come we're not seeing inflation?
Morley explained that.
Well,
basically, you're in the world of technology. What drives it is when there's too much demand and not enough goods for what you need. We've been able to handle that. There is some inflation. but it's only in small sections of the economy. You want to buy a house in a nearby suburb of Philadelphia or New York, it just went up 15% in the last 3 months. People are getting out of the city right now. That'll probably be reversed in a few years, but for the time being, so that's gone up. The cost of lumber, all materials prices have gone up. Raw materials have gone up increasingly. So that hasn't all passed through to you at the time. Okay. You will see that coming up in 22, late 21 and 22, probably.
But to my understanding, I could be wrong, that's not driven so much by financial pressures as it is driven by the virus, as people are moving out of the city and into the suburbs.
Also demographics. You have your 30-somethings that have finally come of age. So now they're moving out of the city also, okay? So the two came together. So part of your demographics is creating that. It doesn't mean you'll have total inflation throughout the country. You will have certain sections. Again, if this lifts, and all of you that I asked, okay, when are you going on your next cruise, your plane flight? All of a sudden, everybody wants something. The airlines are going to raise airline fares 25%. I think you could go to Florida. Somebody called me to say they got tickets to go to Florida for $14 during the summer. Okay, hey, great,
Sure.
Take advantage of it if you want to go to Florida.
So all those examples are demand driven, but I was always told
over limited supply. The supply isn't unlimited.
Yes,
okay?
That's
we've
true.
become more efficient, as Morley says, we've become more efficient in technology so that the Amazons, the Targets, the Walmarts on consumer goods are constantly out there beating the bushes and beating the competitors and the suppliers to keep it low because the competition is so fierce.
Yes.
However, if this lifts, you will start to see prices go up for the restaurants that can stay open. I've been to a few of them eating outdoors. Prices went up. They're trying to make ends meet.
Yeah, there's a state that added a COVID tax onto the restaurant bill.
Absolutely.
Yeah.
Who else? Oh, my dentist added it on. Okay.
Yeah.
Because of the equipment that he has to have all the people that clean your teeth and the mask. Hey,
Right.
you know what? You don't want to go to the dentist. Don't pay it.
But the point I'm asking about is
Yeah.
that when I was younger, all things being equal, I was told, or the financial folks, the community would tell us that all things being equal, just if you printed more money, the fact that there was more money thrown out there, it would drive up inflation because now money was so-called cheaper because they were printing more money.
Yeah.
Yet here we are printing more money than ever before, and it didn't seem to have any effect on inflation.
It's such a huge economy that you have to wait for it to work its way through. Okay. Plus high unemployment.
Yeah,
Demand is very moderate right now. As we get to whatever the new normal is, maybe it'll be close to the old normal. I don't know any better than anybody else. You will see inflationary pressures set in. The Fed will address it. It's just hard to know if that's going to happen on, May 24th or October 13th of next year or January of 22. I have no idea because nobody seems to know what this virus is about, how bad.
Do you think the Fed will address it by raising rates, perhaps?
I think they'll be reluctant to do it. Okay. I think.
So how will they address it?
They'll be reluctant to do it unless they can start to see the light at the end of the tunnel. Okay. That's when I think they'll start to consider raising rate. But again, interest rates in the market, watch the 10-year. I've said that before. The 10-year is even creeping up a little now. Watch the 10-year over the next 6 to 12 months, and interest rates may start to edge up. Again, possibly demand and supply. There are a number of things that are going on right now. The Fed will address it when they have to. That's what they're telling us.
Mike, in terms of what Jerry is asking about the inflation, seems to me as though the Fed is soaking up many of the bonds, and so in effect, there's not a lot of need to have high interest rates to.
Correct. They're keeping a stable bond market. You're absolutely right.
And as
Because
far as
even
what
the
you
muni
mentioned,
market, the muni market rallied, okay? And these states and cities, the municipalities are in debt past up their eyeballs because everybody at this point knows that the Fed will step in. And they don't have to step in. They just told them they'll step in. So the markets are working normally now. Thank goodness for that. This Fed has done a good job in addressing this particular pandemic, for sure.
I look at it this way, the law of supply and demand. If there was a big demand to borrow money, rates would go up. There's not a big demand to borrow money. Corporations have more cash than they've had in a long time. Individuals like ourselves have a lot of cash because they're not spending a lot of money. So there's no big demand to borrow money. And that's why rates are staying low.
The only demand that you'll be seeing is in the municipal market. And in the municipal market, they're doing everything. Did you notice at the gas pump in New Jersey, gas has gone up 8 cents. That's all the state tax, okay? There are going to be very shortly in the next, I don't know, 6, 9, 12, 15 months, there'll be other ways that the states are going to have to raise money. The good news is that it's almost going to be every state in this country. So the federal government is going to print more money. There will be some kind of aid for the states and the municipalities sooner or later. Sooner on the Biden side than on the Trump side, but there will be a little reallocation. As that money works its way through the system, okay, there will start to be some reasonable inflation. How much? It's hard to know. Morley makes a good point that technology is offsetting some of that. It's probably too early to tell right now where that's going to be because we're barely recovering. We're still working with high unemployment, new unemployment claims, and everybody's trying to adjust to this new environment. And again, as Morley says, many people, consumers, especially in the 55 to 85 range, are hardly spending money. They're not going anywhere. They're afraid they're going to get sick, okay? So there's no demand for any of these goods that we're talking about, or less of a demand. I shouldn't say there's no demand. So that's something to be aware of. When that's going to change, stay tuned, okay? It's hard to know. If this virus is going to rear its head again in the next couple of quarters, it's going to be a tough go for the next couple of quarters, okay? And maybe we're looking out into next late spring and summer next year, depending on, you tell me, the vaccines, which vaccine, how we're going to get it, are you going to be comfortable in it? And then even once you get the vaccine, some of you said, hey, I'm not doing it until the next guy does it, or I'm going to see if anybody gets sick from that. So this is going to be a real slow go. We'll see. Let's see what the 30 and 40 somethings have to say. So adult children and so on and so forth. But there are a lot of things that are going to be permanently damaged. How many people aren't going to be commuting to work, okay? Because they could work remote. I'll tell you this, that my company had guaranteed everybody a job through January, okay? We have a tremendous support staff in Morgan Stanley. We employ 61,000 people along the world. If this stays tough for the next year or two, we're going to tighten up the purse strings a bit, okay? That's for sure. And every company is going to do that depending on how they're affected by this, some more than others. You're looking at layoffs on the airlines already, and they're going to continue to do that. The cruise ships are mostly international, for the most part, employees, I think, that are there. Watch Hilton and Marriott in the hotels, okay? So I think, like I say, stay tuned. This isn't over yet.
All right. Are there any other questions for Michael or Morley? If not, Steve always helps me with the video and editing it. And once that's done, we'll post it on the Stonebridge Investment Club YouTube channel, and then we'll send out a notice.
Thank you, Len. Thank you, everybody. Thanks for answering those.
Thank you.
Thank you.
Thank
Thank
you.
you.
Thank you for your opinions.
Okay.
I'll talk to you offline, Steve.
Thank you. Very interesting meeting.
Okay.
Michael, are you out of Red Bank, Michael?
No, I'm out of Princeton, Lawrenceville.
Okay,
Yeah, Lennox Road area.
okay.
Thank you.
All right. I think we'll call it a night.
That's great. Thanks.
Okay, thank
Good
you.
night.
Okay.
Good night. Thank you.